Hey guys, this is Terry with Futures.io. It is my honor to welcome Ryan Curran from Curran Unger LLP for today's webinar, Tax Topics for Traders. The bullet points for today's webinar are making the mark-to-market election, mechanics, issues, and implications, trader tax status, tax benefits of qualifying as a professional trader, how to qualify for trader tax status, specifics and possible pitfalls, and a Q&A for the members. Now please feel free to type your questions into the questions box during the webinar, and we'll do our best to answer them at the end of the event. If you're watching this on YouTube, please do us a favor and give us a thumbs up if you enjoy the webinar. And as always, please feel free to share, comment, and subscribe to our channel. It really helps us a lot. You can follow us on Twitter, Facebook, and YouTube at Futures.io. And without further delay, I'll hand it over to Ryan.
Thank you, Terry. Appreciate it. And thanks again to Terry and Mike from Futures.io for allowing me the opportunity to present. I really appreciate it. So I just started sharing my screen. Let's dig into it here. So the name of the topic we're talking about today is just tax topics for traders. There's a variety of different things we're going to be discussing. Some of them are fairly broad topics, but I think you'll find them informative. A little bit about me. I've been involved in public accounting for 9 years, and I've worked with a variety of different firms before I started my own firm about 4 years ago, and we've experienced a good amount of growth. Most of it's been organic, just growth through our network, and we try and do as good a job as possible, and we really value our clients and so on and so forth. One recent addition to my credentials in the past year was I finished law school and passed the bar, so I'm just waiting to be admitted to practice law, but my focus will be tax law and just continuing to operate the firm, continuing to provide advice to our individual and business clients. I have my information here, so after the webinar, if you want to chat or send me an email, we welcome feedback, we welcome questions, so please feel free. So let's dig into it. So I'm just going to give you a brief summary of the presentation here. So first and foremost, we're going to be talking about the mark-to-market election. We're going to dig into some discussion and some strategy. Secondly, this is a topic that I kind of added recently. I thought it'd be very beneficial to the audience, considering that many of Futures.io subscribers are futures traders, and this stuff is very relevant. So we're going to talk a little bit about Section 1256 and Form 6781. Next up would be the trader tax status. We'll have a discussion about benefits, qualifications, and various other attributes. So let's dig into it here with the mark-to-market election. So first and foremost, the implications of the mark-to-market election. So I'm sure many of you are familiar with this stuff, but we just want to kind of dig in and just lay out the facts and kind of frame our discussion here. So mark-to-market election is allowed by the Internal Revenue Service under Code Section 475, very, very preferential provision of the tax code that's specifically for traders, dealers in securities, so on and so forth. It's one of the few attributes of the tax law that provides significant benefits for a particular class. And the gist of a mark-to-market election is that if it is properly made, it allows the taxpayer to essentially recognize ordinary income or loss to the extent of any unrealized trading positions in the taxpayer's account at the end of the year, in addition to any realized losses that may be sitting in a trader's account based on performance during the year. So the benefit of this is that this $3,000 capital loss deduction limit is basically eliminated. So without making a mark-to-market election, if you're trading securities, we'll just talk about a share of Apple, for example. A loss on a share of Apple would be limited to $3,000 during the year. So if you lost $50,000 trading, you're only able to take advantage of $3,000 during a particular tax year, and the remaining losses get carried forward. So it can become a real challenge to recognize a tax benefit even though you've lost money based on this $3,000 capital loss limit. So the mark-to-market election basically eliminates that threshold and allows one to fully capture their losses from trading in the year that they are incurred. And additionally, the unrealized possessions are also settled at the end of the year. What this does as well is it essentially changes the character of the security from a capital asset, which gives rise to capital gain or loss, to really a business asset. And that's where the position for ordinary income or loss treatment comes about. Once the mark-to-market election is made, it stays in force unless you are granted a revocation by the IRS. And it's very challenging to get one. There has to be a set of quote-unquote unusual circumstances in order for the IRS to allow it. So you have to give careful thought to making the election if you decide to do it with a particular entity or your own personal trading accounts, because again, if it is granted, then that treatment governs all future activity with respect to the entity or the individual taxpayer making the election. So just to kind of outline that, it's very important to understand, if you have a trading account in a business, in an entity, a separate trading entity set up, and you decide to elect mark-to-market election, or excuse me, you make a mark-to-market election on that particular account, and the account ends up transitioning into something that, instead of being shorter term in nature, maybe you want to store some longer term positions there, and you end up realizing, you'd be in a position where you could realize some long-term capital gains. That would not be allowed if a mark-to-market election is made. Regardless of the holding period, the sale of that particular item will give rise to a ordinary income or loss item. One of the great things about the mark-to-market election, this is something that Code Section 475 provides to us, is that you can actually segregate your different types of securities. Meaning, if you wanted to transact in regular common stock, you could do so in a separate account, and a mark-to-market election can be made just on that particular account. And then if you have some 1256 contracts, if you have some regulated futures, some Forex, etc., it can be traded in a segregated account, and then you can actually maintain your beneficial tax status on the Section 1256 stuff, which is, if you're trading futures and you also dabble in other securities, I mean, this is certainly the way that you'd want to organize the trading accounts, because you can get the best of both worlds. I mean, that's really the bottom line. The mechanics of actually making the election. So it varies based on the type of taxpayer. So as an individual, if you hold trading accounts in your personal name, there's a certain method to making an election. And what you do is you must file the election by the due date of the tax return, not including extensions, for the prior year. Very confusing, a mouthful. The example I've outlined here I think is very clear. So let's use a relevant example. If, as an individual, you want to make a mark-to-market election on securities positions that you hold now, for 2017, you have to make the election by April 15th of 2017. And you make the election by either attaching a statement to your tax return for 2016 if you're filing it on time, or if you have to go on extension, you must attach the mark-to-market election with the extension. And it's basically just it's a simple statement that you would really just put down on just a normal piece of paper, just outlining that the taxpayer is hereby electing to make an election under Section 475F of the Internal Revenue Code. You literally attach that to your extension and mail it to IRS certified. They receive it, and your mark-to-market election will be enforced for the 2017 tax year. It's much more difficult if you have an existing business that wishes to start dabbling in mark-to-market types of elections. So if you, let's say you have an unrelated business, a widget business, for example, and you happen to have some marketable securities, futures, etc., in a trading account titled to that business. And then let's say during the year you wanted to request mark-to-market election for the particular business. There is a totally separate method of doing this and a different due date. And essentially the election must be made in the same manner as an individual by the due date of the prior year return. So for, again, giving an example, if you want it to be enforced for 2017, the election must be made by March 15th of 2017. But in order to do so, you must file a Form 3115, which is a totally separate form. It's very daunting. It's an 8-page form with numerous different options, and it is very confusing. But you know, as with much of the things with the tax code, unfortunately, that's kind of how it is. But in any event, you fill that form out. It is called a change in accounting method, and then you'll either attach it to your tax return for the business for 2016 or the extension of the time to file the return. And one important thing to note here, and the same logic applies if you're an individual, you're a business, etc. So it's an as-of-right election, which means that it cannot be denied if it's properly filed on time. So that's an important thing to highlight. The easiest way to make a mark-to-market election is essentially setting up a new entity that's specifically for the purpose of trading. So if you form a new entity and you basically title a securities account in this new entity's tax ID and name, you can have mark-to-market treatment right from the start. The IRS just requires that you maintain an internal mark-to-market election in your books and records. So it's a very easy burden to meet, and the guidance the IRS provides gives one, frankly, a little bit of leeway to make a decision as to whether or not they want to elect mark-to-market. Basically, the reason that I'm trying to highlight this particular point here is because I feel very strongly that if one is going to actually pursue professional trading, setting up a separate entity, I think, is just the most clear-cut way to do it. It just makes it very, very straightforward. It provides a little more clear purpose to the business. It's not like you're mixing. If you have an individual return, it's not like you're mixing your individual activities. You have a specific trading business. That is the business. That's how it's registered with the IRS, and you can have it be mark-to-market right from the start without having to jump through any hoops, so to speak. Now, the same reasoning applies here with respect to any kind of revocation of mark-to-market treatment. So if in 2017 you form a new trading business and you've internally elected mark-to-market treatment, and then when you file your 2017 tax return, you report any gains and losses from mark-to-market on your tax return, then going forward you have to do the same thing. You would need to actually obtain a revocation from the IRS if you wished to change it in 2018 and beyond. One kind of a novel point here regarding sole proprietorships and single member LLCs. To my knowledge and based on my research here, there's really no clear-cut guidance with respect to how the mark-to-market election works with these two types of entities. I'd say as a point of reference, if you did not want to set up a totally separate business entity, you could obtain a sole proprietorship tax ID from the IRS and make the election with respect to that tax ID, and just make sure you register the sole proprietorship with whatever state you're operating in, and that should be adequate in order for the mark-to-market treatment to be in effect on sole proprietor activity. Some issues with making the election. So the due dates that I outlined before are hard and fast. There is really minimal in the way of late filing relief if this election is missed for a particular year. I mean, if you missed the date, so for 2017, if you missed the 4/15/17 deadline as an individual, and you make it on 4/30/17, for example, it's late. It'll be in force for 2018, but not for 2017. So, unfortunately, there is little in the way of late filing relief. There is a general Internal Revenue Code administrative guideline that allows the Commissioner of the Internal Revenue Service to grant a late election, and there are two requirements, but the burden is very hard to meet if any trading activity has been done. Generally, it's you need to immediately correct the mistake if you discover it as soon as you discover it. Excuse me. And secondly, and more troubling, is that it doesn't prejudice the IRS. And essentially, what that means is, if the IRS grants you this late election, and the granting of the late election will result in your tax liability decreasing, they will deny it, carte blanche. So I haven't seen any case in tax court that's been successfully litigated and that the petitioner has overcome that burden if they actually benefited from, if they were going to benefit from making a late election. So it's a big problem. The other thing here that I kind of highlighted earlier was that there's a removal of capital gain or loss treatment on securities, and really if you're not thinking about it clearly, or you're not, say, paying attention to where your positions are segregated and what accounts they are, if you have a lot of unrealized, like, longer-term gains, or if you decide to start holding securities for a long term, it could be a real problem. So it's very, very critical to make sure that if you're going to make the mark-to-market election, you understand the implications and you have the correct strategy in mind, and also that you're segregating the accounts the way that should be. With futures traders, this kind of goes to the segregation point I was trying to make. So when you make a mark-to-market election, a person who makes the election can make kind of just a blanket election that relates to all securities, or they can specifically state in the election itself what securities it relates to. So if you have 1256 contracts, excuse me one second. If you have Section 1256 contracts that you're trading, and again, you also have common stock options, etc., you're going to want to be very careful with respect to how you make the election. You're only going to want the election to apply most likely to common stock or options, simply because of the tax benefits that are inherently associated with Section 1256. So 1256 contracts, generally, just to give you a little bit about them, they're already marked to market at year-end, and any 1099-B forms you receive from your brokers are going to indicate that aggregate profit and loss number. The beauty of the 1256 contract is that it gets a 60-40 split with respect to long-term capital gains and short-term capital gains. It's really a unique treatment. I'm really not sure why the government allows it. They have the holding period requirements for normal common stock or other types of securities that are not Section 1256. But this is a huge benefit. And an issue with making a mark-to-market election with respect to Section 1256 contracts is that this treatment goes away. So everything in mark-to-market is ordinary income or loss. With 1256, it's 60% long-term capital gain, 40% short-term capital gain. So you don't want that to go away. So again, this is where segregation and proper planning and strategy are absolutely crucial. I want to talk a little bit about Section 1256 and the Form 6781, which I'm sure many of you are familiar with. So I'd recommend, if you have questions about what specifically falls under the Section 1256 contract, just take a browse at the Internal Revenue Code 1256 and read it. It's pretty boring, pretty dry stuff, but it's very informative, and I mean that's the law. So it has all the information that would be required to evaluate whether the security you're trading kind of falls within the scope. At the end of the year, any Section 1256 contracts are ultimately reported on Forms 6781, and that's where the 60-40 capital gain and loss allocation takes place, and that's where all the quote-unquote magic happens with respect to Section 1256. Now, 1256 also allows for these actually pretty interesting and very complicated elections. There's 4 different types of elections that are available to traders with 1256 contracts. The one that is most common and frankly very beneficial is the net Section 1256 loss election. And what this election allows you to do is, let's use an example where if you lose $50,000 trading 1256 during the year, you don't have to have it allocated to scheduled date. You don't have to have that $50,000 be allocated 60% long-term capital loss and 40% short-term capital loss, which would result in being limited to $3,000 capital loss, and you carry forward the remaining balance, and you get into the whole kind of issues with not being able to utilize losses from trading, which we want to use. There's a situation where if you have prior year 1256 gains, you can actually carry back the losses. You can make an election right on the form to avoid having any of the loss utilized in the current tax year, and you can actually carry it back 3 years to offset other 1256 gains, and then you can carry the remaining amounts forward. So if you had a fantastic year 3 years ago, and you ended up paying some tax on account of it, and then 3 years down the road, or even 1 or 2 years down the road, you didn't do so well, you lost some money, this election will allow you to carry back that excess loss and apply it against those prior gains, potentially garnering you a tax refund on the, on any kind of prior losses. Now, one point on that, because it's very crucial with this statute of limitations on amended tax returns. So you generally have 3 years from the original due date of filing a tax return in order to amend it for a refund. And what that means is if you have a loss, let's say you have a loss in 2016 on 1256, but you had a gain in 2013 on 1256, you have to get that return, the amended return for 2013, filed by April 15th of 2017. So you got to be very quick with kind of organizing your year-end tax information, getting your 2016 returns done, and then ultimately carrying back that loss. It kind of goes to more of a fundamental theme when it comes to professional trading, and when there's a significant amount of trades going on, you must be organized. You must have, a good gains keeper, so to speak. You must be tracking your positions in order to make these kinds of decisions. There are also straddle elections, and this is kind of where I was talking about this being fairly complicated. So I'm sure many of you are familiar with straddles. The IRS specifically defines a straddle as an offsetting position with respect to personal property of a type that is actively traded. Personal property meaning, by the Internal Revenue Code definitions, really securities. So a long and short future position would constitute straddle. So there are mixed straddle elections that can take place, and there's 2 other, again, more complicated straddle elections that one can take. And the interesting thing about these is that if you have a large built-in gain on one side of the transaction and then a large unrealized loss on the other side of the transaction in a particular straddle, you can actually make an election not to realize the gain on the unrealized gain on your positive position and pick up the loss on your loss position. So with respect to tax deferral or using these unrealized losses to shelter other capital gains or other ordinary gains you may have, a creative mind, someone who's really got their positions in order, can decide whether or not these elections make sense. And it does take time to do it. It takes time for a professional to review these and make a determination. It takes time for you to do it. So the amount of money that you'd be benefiting, you really need to make sure that it's worth it. I'd say, just as a kind of a point of reference, if we're talking about, maybe a $20,000 to $30,000 swing in tax, or excuse me, in capital loss, it might make sense to investigate whether or not the straddle election is worthwhile. Moving on to trader tax status here. This is a really fun topic and very relevant, and something extremely beneficial if you're really engaged in the art of trading, so to speak. So trader tax status is just a term that's used to refer to a person whose active trade or business, as defined by the Internal Revenue Code, is trading securities, whatever securities that may be. So if you can actually carry the burden of being a professional trader, you can take advantage of any deductions that anyone else who runs a business would take. I mean, again, home office, phone and internet, subscriptions, terminal charges, computers, perhaps even mileage if you're driving to different events. You're networking with people, you're picking up things for the trading business. Retirement plans, absolutely critical. This is one of the biggest benefits of being considered a professional trader. self-employed health insurance, and then again, any other business deduction that's available to other persons who are carrying out any kind of business are allowable to one who is a professional trader. So very important to, if you can qualify as a professional trader, to take advantage of this stuff. A common misconception that comes up more and more is that a taxpayer can only qualify for trader tax status if they make a mark-to-market election. And it's totally not true. So you can keep capital treatment on any securities. It's your call. That's why it's a mark-to-market election. Excuse me. So these are just two independent processes. And trader tax status allows you just the benefit of taking advantage of business expenses that we discussed. Again, home office, retirement plans, office supplies, things of that nature. Whereas mark-to-market election is specifically related to the treatment of the securities of the positions that you have traded or hold at the end of the year. So it's two separate things. Trader tax status is specifically for business expenses, and then a mark-to-market election just governs how the sales of securities are treated at the end of the year or during the year. And it's a highly fact-specific evaluation, and each taxpayer situation is different. There really isn't any kind of golden rule, but there are certain best practices that one would want to follow in order to give themselves the best possible chance to qualify if the IRS were ever to audit them. So there's various different entities that one can form basically to take advantage of trader tax status. I want to discuss kind of each of these. So first and foremost, individual taxpayers. If you're just making, if you just have trading accounts and you're doing a lot of day trading or what have you, this would relate to you. If there's no separate entity set up, this is for persons in that particular position. So one of the pitfalls, in my opinion, of being an individual taxpayer that is electing trader tax status is just the general IRS audit risk related to a Schedule C, and especially a Schedule C that has significant losses each year, which is the default treatment of trader tax status for an individual. In other words, an individual without a separate trading entity is always going to be deducting their business expenses for trading on Schedule C, and they're not going to be reporting any income on Schedule C. It's not proper to report any income from trading, any profits on Schedule C. It's just expenses. The income from trading, if you've made a mark-to-market election, are reported on Form 4797. So this pattern can really raise a lot of red flags with IRS, and it, in my opinion, again, it just really creates an unnecessary amount of audit risk, and I just don't think it's worth doing, especially when you can set up a separate entity for a relatively low cost. Other items. There are no business retirement plan contributions that are available, and as we discussed, I mean, that's really a critical and very beneficial component of carrying on any kind of professional self-employed business, which is, what you're doing if you're a professional trader, if you're really actively engaged in this. So again, my suggestion is look at forming a separate entity. It's certainly worth the cost, and based on these things, it'll reduce audit risk and so on and so forth. Business taxpayers, kind of going back to the point I made with individuals. So IRS audits, generally speaking, in my experience, they're extremely infrequent with S corporations and partnerships. It's just something I don't think the IRS has allocated resources to adequately. But again, out of the many tax returns that I've prepared and entities I've been involved with, I just haven't seen businesses get anywhere near the same level of scrutiny that individuals do. Whether that's right or wrong is a different conversation, but I mean that's just my interpretation and an empirical experience with the situation. So if you have set up a separate trading entity, you have the ability to do a SEP IRA or an individual 401k when using an S corporation. An S corporation as a tax status, you'll want to be an officer of the corporation, and you'll have to take a W-2 salary, which means that the corporation essentially pays you a ongoing paycheck. And from there, you have the ability to set up a retirement plan through the business. And in effect, if you have profits from trading, you'll be able to utilize those profits to fund retirement plan contributions on your behalf, which is a great advantage and something that, if you're a successful trader or you want to aspire to do that, it should certainly be on your radar. You can also do something similar with a multi-member LLC. This involves not a physical paycheck, not a W-2 to the partners, but it would be something called a guaranteed payment. You can be eligible for an individual 401k, you can be eligible for a SEP IRA through the LLC, not an individual 401k with the partnership. It just becomes a little more difficult to defend. It gets into very technical reasons about self-employment income. It's kind of outside the scope of this particular dialogue. So S corporation is certainly something that I'd recommend evaluating if you're going to go down the entity route, or if you already have a trading entity that has not elected to be taxed as an S corporation. Health insurance, you can also pay yourself through the business and take a deduction for it. And the beauty of that is the IRS, as an individual, has made this very high threshold for being able to deduct medical expenses. It's 10% of adjusted gross income, which is a high burden to overcome. As a self-employed person, you can deduct the entire health insurance contribution without having to worry about the 10% threshold. So it's just, again, another benefit for having an entity. Another important item of kind of tax law here is, if an entity is set up as a trading entity, it's very hard for the IRS to argue that it's something totally unrelated if all you're doing in that entity is trading. Whereas as an individual, if you're working a part-time job or maybe even a full-time job, and you're engaged in a significant amount of trading, and maybe you have a rental property or something else going on, there's a lot more there for the IRS to grab at. So an individual in this situation is going to be less advantaged than a business for those exact reasons. A business, when you form it, you can actually, you tell the IRS basically when you're forming this entity what the purpose of the entity is. So if you're forming the entity and you say it's a trading entity, it's an investment entity, things of that nature, right from the start, it's very clear what the activity is. So you're starting off on the right foot immediately. To qualify for trader tax status, and as I mentioned, there's really no hard and fast rule about it per se, and there's some case law. You have to be engaged in the business of trading. You can't be working a full-time job 80 hours a week doing something unrelated, and then you make a couple bad trades during the year, even 100 bad trades, and you lose $50,000 trading, and you try and write off the entire amount. It's just not going to fly. If it gets audited, the IRS will totally disallow it. So you have to maintain the appearance and actually be involved in the activity such that an outside party could view it as a business, and just basic things to kind of keep in mind and make sure you're doing. I mean, 1,000 trades a year, there's a lot of information out there that's a safe harbor. I mean, I tend to think it is, just based on what's out there from the courts. So certainly involved in at least that many trades, executing one trade a day, things like that just demonstrate that you're paying attention to the markets, that it is something that you're doing on a regular basis. Maintaining a calendar is critical, in my opinion, and that's been demonstrated as well in court cases. Even as simple as clocking in and out. Just if you have a 40-hour work week, make sure that you're indicating, what you did during the week, what you researched, what positions you were thinking about, what webinars you watched. So I'd expect that you'll put this down in your calendar, right? Things like that to kind of bolster your proof that you are a professional trader if anyone were to ask, if the IRS were to come in and audit you. Full-time job, if you have a full-time job, it's going to go against a professional trader if they're audited just because the IRS, again, they're looking at how much time you're spending, if it's actually a legitimate business, so on and so forth. The portion of your income generated from trading is critical. So kind of going back to the point I made, if you have a full-time job that you're making $100,000 a year and you're losing $50,000 a year trading, it's kind of obvious that that's not a sustainable activity for you to do. You have to be in a position where you are making money. You have you're fulfilling your livelihood by trading, and those are things the IRS is going to look at as well. And as I said, just to reiterate, I mean, you have to maintain the appearance of a business. Be very regimented, documented, separate office. The more information you can put together, the more kind of backup and support you have if anyone were to ask, the better. If you want to read a particularly relevant tax court case about this, I recommend Holsinger versus U.S. Tax Court. 2008 was the case. And yeah, I mean, that's kind of what I have here. I just want to thank everyone for participating, and I'd like to take some questions. Let me just end this here.
If you can go back to your slide that has your contact information and just leave it on that slide during the end of the video.
Sure.
And in that way, if they have any questions afterwards, they can contact you there. Let's see. There's a couple questions. Now, this relates only to the U.S., correct? Not the U.K. or any other nation?
The U.S., yes.
Okay. For a part-time trader, is it better to have a business or file as an individual?
It would be better to have a separate business entity as a part-time trader, just for the reasons that I mentioned, that if it were to ever get looked at least you can demonstrate that you have this business that in and of itself is exclusively a trading entity. So it will make the burden a little bit easier for the taxpayer to maintain. So I'd recommend if a part-time trader within reason, set up a separate entity. I mean, if you're doing 10 trades a year, it doesn't make sense to do that. But if it's 100 trades, 200 trades, if you're spending 20 hours a week, I think it makes sense to have a separate entity.
Okay. Does the MTM election in any way affect the wash-sell rules?
Yes. So MarktoMarket Election eliminates the wash sale. So that's another benefit that I did not mention in the slide, but it gets rid of the wash sales. That's correct.
Okay. And if MTM cannot be revoked, must it still be declared each year or only once the entity is first set up?
Very good question. It's only once. So what would happen is if an entity was set up for MarktoMarket specifically, and then you decided that for whatever reason, if you couldn't segregate the accounts, you would just basically set up a new entity to engage in normal trading. But this is an important point. The fact that you're allowed to segregate positions means that there really isn't a need to do that, and that's why it's very important to be specific with the MarktoMarket election with respect to what securities are particularly covered by it. And by that I mean if you want to have 1256 treatment on futures contracts, but you also want MarktoMarket election on common stock or other options, just set up two separate accounts, right? And one account specifically should only be 1256, and the other account should be common stock and options. And if you actually engage in that type of segregated treatment, and you're very careful and meticulous with record keeping, then there won't be any issues. There really won't be a need then to revoke the election.
Okay. Does a 1256 loss apply to LLC as a carryback?
So as a loss, it'll flow through to the individual, and then the individual can carry it back on the individual tax return.
Okay.
So an LLC has complete flow-through treatment, and even an S corporation is the same thing. So S corporations and limited liability companies, whether they're single member or multi-member, are pass-throughs. In other words, all the activity at the entity level flows to the individual, and then the individual reports that activity on their personal tax returns. This is as opposed to C corporations. A C corporation is not a pass-through. So anything that happens within the C corp is kept to itself.
Okay.
But the LLC and S corporations, ultimately, any activity, any trading activity in there will flow down to the individual.
Okay. Okay, let's see. Regarding TTS, I understand the issues at the federal level, but there could be significant state tax issues. For example, if one lives in a no-income tax state, then making the election might transform revenue from non-taxable to taxable. My question is, does the TTS election really mean business in the same sense as used in many states' tax codes? If so, claiming to be a business with the IRS probably means you would have to claim to be a business within the state or local municipality, correct?
That is not correct. It's based on the entity type, and it's based on the state. So if you're talking about a state like Texas, for example, where there is no income tax, but there's a franchise tax, if you have a business entity that you formed with the IRS, so let's say you formed a corporation, a Texas corporation, you're going to be subject to franchise tax regardless. You're still not going to be triggering any kind of personal income tax liability. So if you're TTS for IRS purposes, it's not going to impact on a state level. It's not going to really give rise to any other out of the ordinary state income tax implications. Meaning that for federal purposes, if you're a trader for tax purposes, you're deducting business expenses related to being a trader, that's not going to trigger any kind of state income tax issues that I'm aware of. I mean, you're just going to be deducting your business expenses for federal purposes, and you're not going to have to worry about anything from a state standpoint. Now, states that have an income tax, they generally will follow federal rules on what constitutes a trader business. So the definition is going to be consistent from one jurisdiction to the other. And oftentimes what happens is, so the IRS, if they were to ever audit someone and recharacterize a professional trading activity and disallow it, the IRS does have information sharing with states. They'd probably follow the state would ultimately disallow the deduction as well. But that doesn't convert taxable income to non-taxable and vice versa.
Okay.
Ultimately, the state is going to just follow their own individual rules.
Okay. I'm a retired doctor and now trade full-time. Is sole proprietorship or LLC better for me? I do not plan on opening an IRA.
So if doctor is going to trade full-time, either entity would be okay, but for the reasons that I mentioned during the presentation, I'd still recommend getting a separate entity set up, just because you want to especially move the Schedule C expenses off of your personal tax return to minimize audit risk. So one thing that some people don't realize is you can form a single member LLC and you can make an election to be taxed as an S corporation. So there's not a need to form a separate corporation per se. You can just elect for the LLC to be taxed as an S corporation and then file these separate tax returns, and you'll get the benefits of having the separate business entity and removing any trading activity from your person. So, Doctor, I'd recommend single member LLC and just make the S corporation election.
Okay. And what is the deadline to elect the professional trader status in 2017 again?
So there actually isn't a deadline. Professional trader status is just something that you qualify for, you don't qualify for based on the facts, and then you can deduct expenses related to it. So by that I mean if you start a business today and it's a professional trading entity, as long as you can support that you are a trader, that you're making a significant amount of trades, that you're investing a lot of time in the business, then there's no election needed. You just take the deductions for any expenses. The only time an election is needed is, if you want to make this mark-to-market election that we talked about. And again, that's separate from trader tax status. So they're not synonymous. Trader tax status is just something that your own operations and activities as a trader give rise to. The mark-to-market election is a physical election that you have to make with the federal government. You mail it in and so on and so forth.
Okay. Do you have any contacts who can advise attendees on tax considerations in Europe?
I don't off the top of my head, but I have some clients that are expats that are professionals, so I could certainly reach out to them. If you want, just send me an email offline, and I'll see what I can do to connect you.
Okay. What about OTC Forex trading? Don't you have a choice to make MTM election or treat as 1256?
So Forex, yes, you can either take it as ordinary or you can keep it as 1256, and that's just done by virtue of how you decide to report it on your tax return. It's what's called an affirmative election, and that's a technical term, and what it means is you're making the election by how you report it.
Okay.
So there's not anything separate you file. If you're going to take the currency trading as ordinary, you put it on Form 4797, and that's the affirmative election that you're treating it as ordinary. If you decide to take it as 1256, you put it on Form 6781, and that's the election that you want it to be treated as 1256.
Okay. I am going to make this the last question. I have a multi-partner LLC. The IRS requires a 1065 to be filed yearly. What is the correct way to file individual taxes for each partner? I'm talking about the 1099-B info from the broker. Thank you.
Sure. So the 1099-B will ultimately be reported on the 1065 for the year, and then each partner will receive a K-1 for their share of the 1099-B, and then they take that K-1 and they report it on their personal return. So as an example, if the 1099-B had $100,000 of income, and you have 4 equal partners, the $100,000 of income is reported on the 1065, and then each partner receives a K-1 for 25% of that. So their K-1, partner A's K-1 shows $25,000 of income from the LLC. Partner B's $25,000, partner C, et cetera, et cetera.
Okay. Perfect. Thank you for the webinar today, the great information about trying to reduce some of our tax liabilities. I definitely appreciate it.
My pleasure. Thanks again, Terry, for having me.
Absolutely. If you have any more questions, please you can email Ryan directly at his email there on the screen, and he will answer them as he can. Again, thank you for the webinar, and we'll talk to you all later.
Thanks, guys. Talk to you later.